Welcome to the deep dive. We're your shortcut through, well, all the market noise out there. Today, we're really digging into this fascinating two-track market that's popped up, came right after the Federal Reserve's latest announcement. We're going to unpack what happened, why it matters for you, and what you really need to keep an eye on in this sort of tug of war playing out. So let's start with yesterday, July 30th. The Fed said they're keeping the federal funds rate steady, right? 4.25% to 4.50%. That's the fifth hold in a row. Now, on the surface, that sounds pretty neutral, maybe even boring, but it wasn't quite like that, was it? Our sources are calling it a hawkish hold. Why hawkish, even though rates didn't actually change?
Exactly. The decision itself, holding rates, that was widely expected. No big surprise there. But the real kicker was Chair Powell's press conference afterwards. He really pushed back hard against the market, thinking a September rate cut was coming. He said very clearly, we have made no decisions about September. And just like that, boom. Market odds for that September cut just plummeted. They went from, nearly 65% down to about 45%. Big shift.
Wow. Yeah. And you saw that ripple through the markets
Oh,
immediately.
absolutely. The two-year Treasury yield, it jumped up from 3.86% to 3.93%. And the U.S. dollar got stronger, too. It was the market basically saying, okay, rates might stay higher for longer than we thought, a clear repricing.
Right. But interestingly, the decision inside the Fed wasn't even unanimous. That caught my eye. Two governors, Waller and Bowman, they actually dissented. They wanted a cut now. Does that signal maybe a crack in the Fed's usually united front? And what were their reasons? They seem different.
It absolutely signals a crack, or at least a fracturing of that unity we often see. And yeah, different reasons. Waller was thinking preemptively, like, let's cut now to maybe head off rising unemployment down the road. Bowman, though, she was worried about the current policy itself, that it might be putting too much risk on continued economic expansion. And you can't ignore the background noise either. You mentioned external political pressure. President Trump pushing for lower rates adds another layer of complexity, doesn't it?
For sure. Okay, so given that hawkish signal from Powell, how did the markets actually react right after? On the 30th. It felt mixed, but leaning negative overall. We definitely saw that divergence. The Dow and the S&P 500 slipped a bit, S&P down 0.12%, but look at the NASDAQ, the tech index. It actually managed a small gain, up 0.15%. Some resilience there. Small caps, though, Russell 2000, they took a harder hit, down 0.5%.
Yeah, that perfectly illustrates this two-track market we're talking about. It was immediate. On one track, you had the companies really sensitive to the economy, think industrials, consumer discretionary, they saw declines. But on the other track, tech just kept marching on. NVIDIA, Broadcom, those semiconductor giants, both up around 2%. Look at specific stocks, it makes it really clear. Generac Holdings, right, big jump, almost 20% up on strong generator demand. But then Old Dominion Freight Line, feeling the pinch from weaker freight markets, down almost 10%. It's like the market sorted them infinitely based on macro sensitivity.
Okay, so that was yesterday's picture. Fast forward to today, July 31st. The pre-market looks, well, sharply higher, driven by just blockbuster earnings from some mega cap tech names, right? Microsoft shares, wow, up nearly 9% after hours. That Azure cloud growth, 39%, is just huge. And Meta, Facebook's parent, rallying 11%. They crushed their Q2 numbers and raised guidance for advertising.
It's impressive, no doubt. But that rally also highlights an extreme concentration. Market leadership is getting really narrow. And all this tech optimism, this euphoria, it faces a really tough test, like right now. We've got a whole slate of key U.S. economic data that just hit at 8:30 a.m. Eastern.
Right, and the big one everyone's watching is the PCE price index, personal consumption expenditures. That's the Fed's preferred inflation gauge. The consensus for June core PCE was 0.3% month over month. We also got personal spending, income, and the latest jobless claims data, too.
Exactly. So this sets up a real tug of war for today's session. If that PCE data comes in hot, higher than expected inflation, well, that just validates Powell's hawkish stance, doesn't it? And it could easily reverse this morning's tech rally. But if it comes in cooler than expected, that could reignite those hopes for a September cut and maybe pour even more fuel on the tech fire.
And let's not forget, more big earnings are coming today, especially after the bell, Apple and Amazon. Those could definitely test this tech narrative further, one way or the other.
So yeah, this whole two-track market idea seems to be holding up quite well. You've got track one, the macro-sensitive market. Most stocks really kind of struggling with the idea of higher for longer rates and maybe slowing growth. And then track two, the secular growth market, dominated by mega cap tech, fueled by AI excitement, and seen as perhaps more insulated from these short-term economic wobbles.
So, boiling it down for today, the main risk seems to be a hot PCE number upsetting the apple cart, the main potential catalyst. A cooler PCE number giving the market, especially tech, a green light. It really feels like investors are facing a choice, don't you think? Chase this concentrated tech momentum or pay more attention to the broader economic signals affecting almost everything else. It leaves you wondering, doesn't it? What does this ongoing battle, this tech strength versus economic reality, mean for your view of the markets right now? And what specific signs will you be watching as this whole situation keeps unfolding?